Hello students, I would like to welcome you all to this video. In this video, I'm going to solve paper 1, specimen paper 7707 is the code for the accounting, Cambridge International, and this paper is for the examination from 2020. We got 1 hour and 15 minutes this time. It's completely MCQs, so we'll have 35 MCQs that will carry 1 mark each. So let's start solving this paper. So we have question number 1 here. It says that what is the purpose of bookkeeping? The options are to interpret the double entry records, to prepare financial statements at regular intervals, to record all the financial transactions of the business, and to summarize the financial position of the business. I normally tell my students always that bookkeeping is related to the recording of the transactions. The bookkeeper that usually do recording up to the trial balance. So preparation of financial statements is the job of an accountant. So here we have option B and option D that directly relates to the work of accountant. So now move on to the option A, to interpret the double entry records. The interpretation work means the analysis or the further detailed work that usually do by the accounting. So the purpose of the bookkeeping is to record all the financial transactions of the business. To C is the right option. So the next question we have the definition of an asset. They ask us, so what are the assets? The items that are bought for long-term use by a business, or the items that are expected to be turned into the cash in near future. So items that are owned by or owed by a business. The items that are owned by or owed to a business. So we know that the definition of the asset is items that are owned or owed to a business, means someone owed to us. So that will be our trade receivables. So that will be the definition of an asset, because the other options that carries only, because over here if we look into this, the items that are bought for long-term use, it only shows the non-current assets. So items that are expected to be turned into the cash in near future, that we usually tell the liquid assets. So here we have owned by a business mean we're supposed to pay to someone, so that means our liability. So the most suitable answer for this question is option D. Now moving on to the next question. Question number 3. Semi-returned goods bought on credit from Javed. How does Javed record this in his books? So if semi-returned goods bought on credit from Javed, so it means Javed sold these goods to Sami before. So from Javed's perspective, it will be sales returns. So the right option for this is the options that has sales returns. So means option B or option D. Now we know that sales returns are debited when we do the double entry. So the right option for this question is option B. Let's move on to the next question that we have here. Is question number 4. It says that at the end of the financial year, there was a debit balance brought down on the office expenses account. In which section of the statement of financial position will this be recorded? As we know that we always have, if we have a debit balance brought down, balance on debit side, it means it will be our asset. So it's normally comes up into the current assets. It will not be part of a capital, because capital has a credit balance brought down always. Current liabilities also have a credit balance, and non-current asset has a debit balance, but it will not have the office expense account. It will usually have the furniture motor vehicle account. So the right answer for this question will be option B. Let's move on to the next question. Question number 5. In question number 5, it says the following ledger account appeared in the books of a trader: rent account, and we have opening balance BD, bank, income statement, and balance CD. What does the balance on 31st December represents? The rent payable outstanding, the rent payable prepaid, the rent receivable outstanding, the rent receivable prepaid. So it's a rent account and it has a bank balance on the debit side. So if we'll make the double entry of this, it means we made the payment of the rent, because the entry will be rent account debit and bank account credit. So it's mean it's an expense account. So if it's an expense account, so rent payable options will be the right ones. So if we have a balance CD here, it will transfer to the other side as balance brought down, the opening balance of next accounting period. So if we have a credit side balance brought down, that means it will be our liability. So the right answer for this question will be option A, rent payable outstanding. In the next question, question number 6, it says that Karim issued an invoice, a credit note, and a receipt. So these are 3 documents that are issued by Karim. So what has happened? Karim purchased goods and paid the supplier immediately. Karim purchased goods on credit, made returns to the supplier, and paid the balance due. Karim sold goods and received payment immediately from the customer, or Karim sold goods on credit, received return from customer, and received the balance due. So if we know that who issued the invoice, we know that supplier or seller usually issue the invoice and credit note as well and receipt as well. So all of these documents issued by a supplier means based on the sales. So the right option will be the goods sold, because Karim sold goods, so Karim issue invoice and receive return from customers, so Karim issued a credit note, and once they receive the balance due, Karim will issue a receipt. So the right option for question number 6 is option D. Now the next question, question number 7. A trader purchased on credit for April amount to 2,000. These purchases were subject to a trade discount of 10% and also a cash discount of 5% for accounts paid within 30 days. So how much was entered in the purchases journal? So in the purchase journal, we only deduct the trade discount, because the cash discount, that is related to the payment. So if he paid within 30 days, then he will get this discount. So the trade discount will be given to him at the time of purchase. So the right answer for this is to deduct 10,000 from 10% from 2,000. So that will be a 200. So the right amount that will be entered in the purchase journal will be after deducting 10% of 2,000. So 10% of 2,000 will be calculated, and it is 200. So now we are going to deduct 200 from 10,000, and it will do from 2,000. So it will give me the answer of 1,800. So the right option will be option B. In the next question, it says which is part of a double entry system, which means that the account that contains both debit and credit. So the options are A, cash book, B, General journal. C. Sales journal. D. Trial balance. So as we know that the part of double entry system is in which we made debit and credit. So the right option for this question is cash book. Cash book is the day book which is the part of double entry system. So let's move on to the next question. Question number 9. It says that what is a trial balance? So option A is a list of balances in the business books on a certain date, a list of assets, liabilities, and capital of a business on a certain date, a summary of all business transactions for the year, a summary of the financial position of a business at the year end. So the right option is option A. It is a list of balances in a business books on a certain date. So the right option for question number 9 is option A. The next question here we have question number 10. It says, which error will be revealed by the preparation of a trial balance? So the options are an amount recorded twice as double entry, a capital expenditure item treated as revenue expenditure, a double entry made using an incorrect amount, a transaction completely omitted from the books. So if we know the errors that cannot be deducted by the trial balance, so we can answer this question easily. The option B is capital expenditure treated as revenue expenditure is error of principle. A double entry made using an incorrect amount is the error of original entry, and transaction completely omitted is error of omission. So all of these three errors cannot be deducted by the trial balance. So the right option for question number 10 is option A. If we write down a double amount on the debit side, that will create a difference. So the trial balance will not be equaled. Now let's move on to the question number 11. Tracy runs a clothing store. She sold a computer with a net book value of 2000 for 1800. The cash was received, but no entry had been made in any accounts. What is the effect of correcting this error on the statement of financial position? So if we'll correct this error, what will happen? Our non-current assets will going to be down by the net book value, and our current asset will going to be increased by 1800, because the net book value of an asset will usually come into the statement of financial position, in which we shows cost less next accumulated depreciation, and will give the net book value figure at the third column. So the net book value will going to be decreased. That means we have 2000 net book value. So the option can be C or D, because it both contains a decrease of 2000, and then we'll get a cash balance. So that will increase our current asset by 1800. So option C will be the right answer. Let's move on to the next question. Question number 12. It says that the bank statement of a business showed a bank overdraft of 1640 on 1st October 2017. At that date, there were uncredited deposit 380 and unpresented checks of 460. What was the cash book balance on 1st October 2017? So they ask us basically to make a bank reconciliation statement. So if we have an overdraft balance, so we'll mention this with the negative figure. So it will be a balance of bank statement. So in the bank statement balance, we add uncredited checks. and we less the unpresented checks. So the uncredited checks are 380 and the unpresented checks are 460. So if we'll do this, we'll get the answer. So here we have minus 1640 plus 380 minus 460, and we'll get the answer 1720, and it is a negative number. That means we have a negative balance of cash book. It will show us on a credit side. So the right option for question number 12 is option C. Let's move on to the next question. Question number 13. It says that what are the sources of information for entries in the control account? So we know that control accounts get the information from the books of prime entry. So the right option for this question is option B, because bank statement, we did not get the information from the bank statement. The ledger accounts, no. The sales invoices, no. It will gives us only sales figure. So the right option for all of these transactions is book of prime entry. So the question number 14, it says a trader provide the following information. So we got some purchase ledger control account opening balance, we have purchase journal total, we have purchase return journal total, we got check paid to the suppliers, we got discount received 1000. So what was the purchase ledger control account balance on 31st March? It means we have to make a control account. So let me make a control account here in a short working. So we know that our opening balance, it is our liability balance, because purchase ledger means it's a payable ledger account. So the closing opening balance will comes up on a credit side, 4000. So the purchase journal total means the credit purchases. It will also increases our trade payables balance, so it will come up on the credit side. So purchase return will come up on a debit side because it reduces our liability, and checks paid to the suppliers as well, it reduces our liability, so that's why it comes up on a debit side. And discount receive as well, it will come up on a debit side. So now we are going to balance it off. So we see that this side has a bigger value, so we got 57,000 here by adding these two numbers, and 57,000 I will move on this side, and I'm going to take out the numbers. So 57,000 less 2,000 less 47,000 less 1,000, and I got the balance, and that is 7,000. So the purchase ledger control account closing balance will be the option A. Move on to the next question. The next question we have is question number 15. It says that Rayan bought a computer, cost 800, and some ink cartridge, cost $50, for use in the business. Both of these accounts were debited to the purchases account. So what was the effect of this error on the income statement for the year? So they ask us the effect of this error. It means they don't want the effect after correcting this error. So let's have a look on. So if we will record the cost of computer and the cost of ink in the purchases, it means our cost of sales will be overstated, because these two figures should not be recorded in the purchases. And the one of them, the computer, it is our non-current assets, so it should be recorded in the statement of financial position. This figure should not come up into the income statement. only the $50 ink cartridge, that will be our expense, so that should be come up into the expenses, so means our expenses are also understated. So the option that we have here is, because of these two figures goes to the purchases, so 850 the total number that included in the purchases, so our cost of sales is overstated by 850, so that will be the right answer, option B, because there is only a one option that has the value of 850 and it is overstated, and you can see that the $50 is understated. Let's move on to the next question. Question number 16. It says that for which non-current asset is the revaluation method of depreciation most appropriate? We have loose tools, we have motor vehicles, we have office equipment, and we have plant and machinery. And we have seen so many questions in which the revaluation method is used for the loose tools. So that's the most relevant method that we have for loose tools. So let's move on to the next question. We have question number 17 here, and it says that Amit depreciates his building at the rate of 2% per annum using the straight line method. He bought land for 200,000. It cost 120 to build a warehouse on it. After 5 years, he sold warehouse for 299,000. What was the profit or loss on disposal? To calculate the profit or loss on disposal of this asset, we have to calculate the depreciation for the 5 years. So the 5 years depreciation will be the 120,000 is the warehouse building cost, so that needs to be depreciated by 2% per annum. So the depreciation rate will be, depreciation amount will be 120,000 into 2%. That gives me 1 year depreciation value is 2,400. So if I will multiply this by 5, so I will get the depreciation value of 5 years, that is 12,000. So the net book value will be 120,000 of the building less 12,000. So that will give me the figure of net book value is 108,000. Plus it got the land, so the land cost is 200,000 because it is not going to be depreciated, so I will write down as it is. So it gives me the total of 308. Now this asset is sold for 299,000, so that gives me a number of loss. So the answer will be, if I will deduct this 299,000 from this value, so I will get the loss number, that is 9,000. Let me double check with the calculator. Yes, it's 9,000. So the option that we have here, 9,000 in the loss, is option A. Let's move on to the next question that we have here is question number 18. It says that why should accrued expenses be shown in the financial statements of a business? So that options are, so that the correct total of the current assets is shown in the statement of financial position. Option B is so that the total income for a period is matched against the total cost of that period. Option C is to show how much customers owe the business. Option D is to show the amount owed to credit suppliers. So the right option is, because as we know, the accrual and prepayment concept is based on the matching principle. So it says that income and expenses should be matched. of a relevant period. So the right option is option B. Let's move on to the next question. Question number 19. It says that a trader sold goods to Zahid on credit. Zahid was unable to pay the amount owing, and the balance of his account was written off, means irrecoverable debt. So what entries will the trader make to write off this irrecoverable debt? So we know that irrecoverable debt is our expense, and then once the expenses goes up, we have to debit the irrecoverable debts. So now we have two options that has irrecoverable debts account on debit side. Option A has sales credit and option B has Zahid credit. So we're supposed to credit the option with the name. So the right entry for irrecoverable debts is irrecoverable debts account debit and Zahid account credit. In the next question, question number 20, it says Sumit maintains a position for doubtful debts at 5% of the trade receivables at the end of each financial year. On 1st January 2016, the trade receivable amount to 3,500 and the provision for doubtful debts was 175. So the income statement for the year ended 31st December 2016 was debited with $15 for the provision for doubtful debts. So if the income statement is going to be debited, it means that's an expense. So expense, once we write down for the provision for doubtful debt, that means our provision for doubtful debts is going to be increased by this amount. So they ask us how much did the trade receivable owe on 31st December 2016. So we got the total balance of provision for doubtful debts. The opening balance that we had before is 175, and now we got the increase, that is $15. So we got the provision balance 190, the total balance, and this figure is the 5% of trade receivables. So if we will divide this by 5 and multiply by 100, so we'll get the trade receivable number. So the right amount for the trade receivable is 3,800. So the option that we have here with this number is option D. So we can double check by multiplying 3,800 into 5%. So we'll get the number 190, and we already have an opening balance of 175. That means there is an increase in the provision of $15. So that's how we solve this question. Let's move on to the next question. Question number 21. It says that which group contain only trading businesses? So we know there are different groups. In option A, we have driving school, we have motor insurance agency, we have vehicle repair business. The second one is driving school, motor insurance agency, a petrol station, motor parts shop, vehicle repair business, and car dealership. The motor parts shop, petrol station, and car dealership. Now the trading business is the business which deals in the products, means they did not make the products, or they did not provide the services. They purchase the goods and they resell them at the higher price. So that's the trading business. So we got option D here, which contain of spare parts shop, petrol station, and car dealership, because they purchase the finished goods, means already developed goods, and sell to others. Let's move on to the next question we have here. It's which statement is correct? The statements are cost of goods sold less gross profit less sales return is equal to revenue. The second statement is cost of goods sold less gross profit plus sales returns is equal to revenue. The cost of goods sold plus gross profit minus sales return is equal to sales revenue, or the cost of goods sold plus gross profit plus sales return is equal to sales revenue. To do this, what I will do the working here. So we have a revenue means sales, and we make less sales returns into this, and we got the figure of cost of sales. And then after deducting this, so once we have a number here, so we'll deduct this from this number, whatever we will have here. So you usually deduct this from this number. So the number that we will get here, we'll deduct this number again from this number, net sales revenue. So we'll get the gross profit figure. Now if we will look into this cost of goods sold, this figure is a positive number. So once it's moved to the other side, so we'll add, because this is a negative number, so this will become a negative number again. So we'll add gross profit, and this number is a negative number. So once it will move on, so we'll add that number again. So the right option would be cost of sales plus gross profit and plus sales returns to get the value of sales revenue. So the right option is cost of goods sold plus gross profit plus sales return. Now let's move on to the next question. We have question number 23 here. How is the capital employed calculated? So we know that capital employed is the owner's capital plus non-current liabilities. So current assets minus current liabilities means working capital. Non-current assets plus current assets will give us total assets. Owner's capital plus non-current liabilities will give us capital employed. Owner capitals plus total liabilities, that gives us total of liabilities and capital. So the right option is option C. So moving on to the next question, question number 24. It says which should be entered in the appropriation account of a partnership. So we know that the appropriation account starts from the profit for the year, and then we add interest on capital, less interest on drawings. Interest on loan does not come into the appropriation account, it goes to the current account. So only these two figures, interest on partner's capital, partner drawings, no, partner drawings did not come up as well. Interest on partner drawings, yes. So because there is a partner drawings, so we'll not record this into the appropriation account. So only the option that we have one tick, that is option A, is the right option. The next question, question number 25 we have here is Meena and Khan are in partnership, sharing profit and losses equally. Interest on capital account balances is to be allowed at 5%. The capital account balance at the start were 10,000 and 20,000. The profit for the year was 28,000. So how much was credited to the Meena's current account at the end of the year? They asked for the total transfer, means the both figures. So once the Meena will get the interest on capital account, so the both partner, they will get based on these capital, they will get the interest based on these capital. So Meena will get the 5% of 10,000, so that will be 500, and Khan will get 5% of 20,000, that will be 1,000. As we know, in the appropriation account, we deduct these two numbers from this the profit for the year. So the profit for the year is 28,000. So 28,000 less interest on capital 1,500 for both of them, so we'll get 26,500. So we will divide this equally because the profit sharing ratio is 20 6,500. So divided by 2 will give us the share of each. So as we know, we need to know about the MENA. So both of them will get 13,250 of profit. So the total figure that we'll get by the MENA is 13,250 plus 500 is 13,750 is the right answer. So the right answer is B. Let's move on to the next question that we have here is question number 26. It says that Z Limited provide the following information. So issued and paid up share capital is 200,000, general reserves, retained earnings and 10% debentures. So what was the value of equity? So equity contains capital, general reserves and retained earnings. It does not contain 10% debentures because these are over non-current liabilities. So we have to make the total of these three numbers. So that will be 200,000 plus 30,000 plus 15,000, 245,000. So the answer that we have here is 245,000 is option C. The next question that we have here is question number 27. It says that the issued share capital of DX Limited consists of ordinary shares. The retained earnings were 45,000 on 1st September. These had increased to 75,000 on 31st August 2017. The company earned a profit for the year of 80,000. So what was the total ordinary share dividend for the year? So we got the opening balance of retained earnings and we got the closing balance of retained earnings and we got the profit for the year. So here we have the column of retained earnings, means we got the opening balance 45,000. We usually add the profit for the years 80,000 into this opening balance and we deduct the dividends that we paid and we got the closing balance of 75,000. So I have to go back to find this missing figure. To do this, I will write down 75,000 and I will deduct 80,000 and 45,000 from this number. So I will get the 50,000 is the answer. So that's the payment that we made for the dividend. So it's the right answer for this question is option D. So in the next question, question number 28, we got a club provide the following information for the year. So they got the receipts, they got payments, they got depreciation charge for the year, they got accumulated funds at the year end. So there were no accrual and prepayments and there had been no capital expenditure or capital receipts. What was the accumulated funds at the start of the year? So to calculate the accumulated funds at the start of the years means opening capital. So the opening capital is calculated by as we got the receipt and payments and depreciation charge, so we can calculate the surplus or deficit from this number. So the receipts that we have is 21,600 and we got payments, so we'll deduct the payments from this number and we know the depreciation is also our expense, so we'll deduct the depreciation as well. So we'll get the amount of surplus or deficit, means profit or loss. So 21,600 less 20,000 less 1250. So there's a positive number, means is a surplus. We called surplus means profit in the clubs and society, means non for profit making organization. So we got the closing accumulated funds. So as we know, the formula we have like opening plus surplus, so we got equals, so we'll get the closing figure of accumulated funds. So we got the closing figure is 15,800 in the question. So now we got the surplus of 350. So once we will move back, so we'll take away 15,800 minus 350. So we'll get this figure 15,450. We always do the wrong way when we go back from this number to this number, because this number is a positive number. So once we will go back, this will become a negative number. So we got the opening balance of 15,450. So the right option for this is option C. So in the next question, we have question number 29. It's again from a club and society. So club provide the following information at the end of his financial year: the rent of premises paid in advance, and outstanding subscription from members. So rent of premises paid in advance is our expense prepaid, and outstanding subscriptions from member, it's an accrual income. So where will these items appears in the club's statement of financial position? So we know that rent of premises paid in advance is a prepaid expense, and prepaid expense will be our asset, and that will come up in the current asset. So option 1 or option A or option B will be the right answer. So let's have a look on the second thing. Outstanding subscription from customer is our accrual income. So accrual income is also our asset because we supposed to receive this money. So the right option is both current assets. Option A is the right option. So next question we have here is question number 30. Okay, it says here, which is an indirect cost? Indirect cost means the cost that is not related directly to the production. So carriage inward is the carriage we paid on the purchases, so it's a direct cost. We record this into the the direct material cost. The factory rent, production material, production wages. The production material and production wages is also direct cost. The indirect cost that we have here is factory rent, because it is not directly related with the production. If we did not make a single product, we still have to pay the rent. So the right option for this question is option B. The next question we have is question number 31. It says a trader provide the following information. So we got capital, opening balance, and we got assets, we got liabilities, and we got drawings during the year 7,500. Now, what was the profit for the year ended 31st July 2017? So what do we have to do? We know that assets minus liabilities will give us the closing capital number. So let's do this. 75,000 less 36,500. So we'll get the closing capital figure. So that will be 75,000 less 36,500 is 38,500. So if this is the closing capital, so we know that opening capital is the same question, similar question that we have done with the accumulated funds earlier, like in question number 28. So the opening capital, we know we have to add profit for the year, and you have to less drawings from this number, so we'll end up with the closing capital. So let's fill this up. So we got closing capital calculated here 38,500. We got opening capital here 25,000, and we got drawings 7,500. So we'll move back from this balance to the upside. So we got 38,500. So I'm going to make plus 7,500 and less 25,000. Again, once we move back, we will change the signs, so we'll get the answer of 21,000. So the right option that we have here in 31 question is 21,000 is D. So let's move on to the next question. We have question number 32 here. A business provides the following information: revenue for the year, purchases for the year, and we got the gross profit as a percentage of cost of sales, means it's a markup percentage. So as we know, the markup ratio is calculated on cost of sale, the gross profit percentage calculated on cost of sale. So what do we have to do? We have to calculate the gross profit. So we got the revenue, we don't have opening and closing inventory, so we can adjust that to find out the cost of sale. So we are going to use this markup ratio to calculate our answer. So let's do this. As we know that revenue less cost of sales will give us the gross profit. So we got percentage of markup. So the percentage we got either markup or margin. So we always write this percentage in front of this gross profit. So gross profit has a number of 25. The percent markup, it means it's calculated on cost of sales, mean the cost of sale figure will be 100. So now, as we know, the cost of sale we usually deduct. So how much will be the number of revenue? So if we'll write down 125 on top of that by adding this, because we will move back, so we'll add 25 plus 100. So we got 125 revenue, we got 100 for cost of sale, and we got gross profit of 25%. So now let's have a look. We got the figure of revenue, so we'll write down the figure 189,000 in front of the revenue. Now to calculate the cost of sale, what I'm going to do, I'm going to divide 189,000 into the number that we have for this figure, so that is 125. So I will divide this by 125 and I will multiply by the number that I want to know. I want to know the cost of sale, and cost of sale number means percentage is 100. So I'll get my answer. So let's do this. 189,000 divided by 125, and I will multiply this by 100. So I will get my answer 151,200. So the right option that we have here is for the cost of sale is 151,200. And to get the gross profit figure, I will just take away 189,000 and I will get the number 37,800. So right option is option B for this question. We can also do like this. So we'll multiply, like if we divide 189,000 to 125 and multiply by 25 instead of 100, so we'll get the answer. So 189,000 divided by 125 into 25 will give me the same answer, 37,800. So that can be another way to calculate this gross profit number. Let's move on to the next question. Question number 33 we have here is Donald. Rates of inventory turnover was 10 times. So the inventory on 1st January was 800 and the inventory on 31st December was 1000. So what were his purchases? To calculate this, we know that the inventory turnover ratio formula is cost of goods sold divided by average inventory. That will be the formula. So the average inventory equals opening inventory plus closing inventory divided by 2. So we got opening inventory 800 and we got closing inventory 1000. So I will solve this and I will get the answer. 1800 divided by 2 is 900. So I got the average inventory figure, that is 900. So I'm going to put this into the formula to get the cost of sale figure. So the cost of sale divided by average inventory is 900 and the answer is 10. So if this number goes to there, so it will multiply by 10. So the answer will be cost of sales is equal to 900 multiplied by 10. So that will give me the answer of 9,000. Now I can use this cost of sale to calculate the figure of purchases. To do this, I know that opening inventory add purchases less closing inventory will gives me the number of cost of sales. So I know the cost of sales number, so I'll write down 9,000 here. I know the opening inventory is 800 and I know the closing inventory is 1,000. So I'll write down like this and now I will work this out. So 9,000 plus 1,000 less 800 will give me the answer. So the 9,200 is the right answer. So in the option we have option C here. So that will be the answer. Let's move on to the next question. So the question is 34. What is the going concern principle? So the going concern principle is the principle that tells us that we don't have any intention to close down our business in next 12 months. So let's have a look on the options. We have option A, the accounting records are prepared assuming that the business will continue to operate in the foreseeable future. That seems to be a right option. Let's have a look on the other options that we have. The income and expenditure should be accounted for in the same way they were accounted for in the previous year. That means the comparability. So it should be comparable. So it is not going concern. The profit should not be anticipated and losses should be written off as soon as they are known. It looks prudence. So the revenue and cost should be recognized and they are earned or incurred not when the money is received or paid. So that's realization. So the right option is for this is option A. So let's move on to the last question that we have from this question paper. So which accounting objective is being applied when financial information affect business decisions? So we have to see that if the business decisions affect the information, financial information, so which accounting objective is applied? So comparability means comparing the data. Relevance mean it should be relevant. Reliability means it should be reliable. So understandability mean the format should be understandable. So the most suitable option is for this because this affects the business decision. Business decisions affect the financial information, so only those decisions will be taken into account those were relevant. So the right option will be for this question is option B.